Hey guys, Mike here. So we get to answer all your questions and stuff today, so feel free to participate, especially on one of these. I think I know the answer to it, but kind of a novice at this one, so I will definitely be looking for you guys to answer this question for one of our viewers and stuff. Feel free to ask more questions for next week's video if you like, okay? So as usual, let's get right into it. And the first one's a pretty good one right here. And Sunshine Happiness asked, how do we watch the bond market? What chart do we look for, or how do we know what it's doing? Well, I'll give you two. The most popular to me is the US 10-year, and you just type in US 10-year. If you have TradingView right here, you can pretty much find everything in TradingView right here, and I'll show you a couple ways to do that. But you know, you've seen this chart before. As the 10-year goes, the market goes, right? And it's not about just small movements here or there. It's these exacerbated moves, right? And then, of course, when it gets to certain levels, the market freaks out. And what we'll do is we'll pull up the SPX over it, which is the SP 500, and you'll see what I'm talking about here. And so again, bond yields can be going up, right? The US 10-year can be going up and the market can go up with it. You saw that right here. But once it gets to a certain level and you start having really like a parabolic type move in these yields, the market is going to sell off. Same thing happens in the opposite direction, right? You can see them, they're going up together right there. So again, yields can be going up and the market can be going up with it. Okay, so people say, oh, the market can't last in like a high yield environment. To a certain point, it can. All right, and you can see right here, as soon as we started dropping down, that precipitous drop right there, the market's just going crazy, right? Especially ones that fell out of this channel and retested certain levels and failed, right? The market went absolutely nuts, okay? And so again, what do you see here? 10-year starts to move up, what happens to the market? Keeps going up, right? Goes up a lot while the 10-year is going back up. But once it hits a certain level, nope, it's going to start to sell off. And that's exactly what happened here. And then when we zoom back over here, of course, again, the bond market does what? Gets to a certain level, starts to sell back off, fall out of this channel. Market's loving life, okay? So definitely track the 10-year for sure. And then the second one I would say track is going to be your high yield bonds, your junk bonds. You can do HYG, JNK, either one, it's not going to matter. But this kind of lets you know the market's risk appetite, because if smart money, which is supposed to be the smart investors, are willing to buy junk bonds, which is the highest risk type bond, right? Then you'll see the stock market go, cool, we'll start buying stock. And so if this is moving higher, the market is going to be moving higher. And this is something you're looking for, because sometimes HYG can tip their hand on really a market reversal or something like that in both directions. And so we're going to pull up the Qs. I'm going to change this out actually. Let me pull up the SPY instead. We'll get rid of this one. And so, you know, we pull this up, you'll see exactly what I'm talking about as far as reversals and everything. But normally when you look at this, they're going in the same direction, okay, so which is a good thing. It's kind of like a confirmation of the market say, nope, smart investors are still buying, you know, junk bonds. We should be okay, right? And again, this is a weekly. We'll go to a daily, but you can see right here, they just go hand in hand, right? And then as we kind of zoom down, if we start to come down here and go to the daily, sometimes what you'll see right here, if you zoom in, see how HYG starts turning up? What's the market doing though? Still selling off, okay? I think right there it dropped another 3%. And so, but you know, HYG is signaling, no, we're going up. So smart investors, they're buying junk bonds right there. All right, so sometimes you'll get to see that, not all the time. And you can also see it on the way down, where you may see HYG turn over before the S&P does. And you're like, oh, okay, wait a minute, this might be giving a signal, right? I mean, you can see right here, it started to turn down, and it'll break, it's like a key level or something like that. And the market will keep going up or sideways, and then finally start to break down and sell off. And so that's another one. Also look at, I believe it's MOVE, M-O-V-E, which is the volatility measurement for bonds as well. Definitely track that one. It's kind of like the VIX, right? So that's another one to look at. I hope that helps you on that. Let me know if you have any questions on that now. And before we continue, guys, please hit that thumbs up down there. It helps people find the video. I really appreciate that. And think about subscribing if you like these kind of videos. Next one says, do you think the market is staying high and going higher, waiting for a rate cut, and then when the Fed cuts 0.25 points, that will drop the market? I think it's a lot more complicated than that, okay? I don't think it's just about rate cuts, okay? Because I've showed you before, there's no rhyme or reason to when the market drops when it comes to rate cuts if you watch that video. But when we look at this, here's the unemployment rate, all right? And we're going to put a few things on here. This might seem complicated, but hopefully you can track it. So here's the unemployment rate. What do you normally see, right? Recession hits, boom, unemployment goes way up, and then it just steadily declines, right? And of course, currently what's happening? The unemployment rate is rising, right? Because now we're at a very high Fed funds rate, and everything. And so it's finally starting to take effect. The economy's kind of slowing. Manufacturing looks like garbage. Services starting to soften as well. Bottom 50% is struggling right now with the feeling of this. And so, if we pull up the Fed funds rate, you'll see right here, just type in right there, Fed funds rate, pull it up. So now we'll lay that over this as well. And we start to look at it and you're like, okay, if I look back at, .com, 08, all the rest of these or whatever, you can currently see where we're at now, right? We're at a high Fed funds rate. You go back to the last rate hiking cycle, see how the employment didn't even pop up really at all. And they already started cutting, right? And then of course we hit 2020. So it wasn't the unemployment they were looking at, right? Here, unemployment starts to turn back up before they start to cut, okay? And then if we go back to the .com, it's almost the same thing. Like right when they made their cut during the .com, they had already started to see unemployment tick up, but not, a great deal, but, 0.05 maybe or something like that. So it's obviously not unemployment that there's so much looking at. It's just one of many factors that are looking at for these rate cuts, right? And when you come over and we'll add something else, we're going to go ahead and say, okay, get rid of unemployment. Let's add in ISM Purchasing Managers Index, right? This is a cycle. Everything goes in cycles. What do you see? Cycle starts after recession. You see unemployment just slowly bleeds down. And then all of a sudden, as the cycle starts to come to an end, it starts going to contraction, which is that white line right there. And so really, this is another factor that the Fed takes into account, saying, whoa, we're really slowing this economy. We may want, if they want to avoid a recession, they have to cut rates, right? And that's when you really see unemployment spike up, right? When we start to go, because that's when people start announcing layoffs, a whole bunch of them. And so that's what happens at the end of every cycle. And then, of course, we have a recession, and then the cycle starts all over again. Now, we'll pull up the Fed funds rate on top of that, right, to see if maybe this is what they're actually looking at as well. So now you got your unemployment, your Fed funds rate, and basically your business cycle or your economic cycle in here, okay? And so when you look at it, again, here's the cycle starting right here. Unemployment's fading down. They're starting to raise rates. This is normal, okay? And then because of these rates, it starts to slow the economy. You see we go into contraction on the business cycle. Unemployment starts to turn up. And then we go into a recession because they start to cut, but they're cutting too late, right? So, and the .com was kind of an unusual one. But again, you look over at 08, you see the same things. It's just the same kind of cycle, right? You can see your business cycle or economic cycle, whatever you like to call it. And then your unemployment is already way high from the last recession, starts to trend down slowly over a number of years. We're at zero rates. They start to raise rates. We go through another rate hiking cycle, and you can see that cycle, how it kind of slows down. Every time it turns up, it's getting lower and lower, right? Then we go into contraction. They start to cut rates. Unemployment's already rising. It's too late. We go into recession. They had to be the financial crisis where the banking system was a hot mess. Now, this one, they held rates for a long time. We came into the rate hiking cycle. Again, you can see unemployment faded slowly. 2020 hit. So we really were interrupted in the cycle, right? And they know this. Everybody knows this. Through the whole cycle off, okay? And what's weird about it now, what do you see? You see unemployment is starting to rise because it was at record lows, like historic lows at 3.3 or 3.4, I think we got to at some point in time. So I think what everybody knows is it looks like we're at the end of a cycle, right? It looks like we're at the end of a business cycle, which is normal. And normally you would hit a recession, right? They would cut before that ever hit and something like that. And then it would spike unemployment up, and then we would start this process all over again. So I think that's really the key question to ask is, are we at the end of a cycle? And the Fed looks at this stuff, right? And so they're trying to, stay it off. But the biggest thing to remember is we have inflation, right? So that's the X factor. And the question is, how serious are they about getting us down to 2%? Or are they more worried about growth in the economy and avoiding a recession, right? Because they understand it's going to take a long, if we ever get back down to 2, it's going to take a lot longer than the rest of this year to do it. You see what happened when you got to 4. And now we're between 3 and 4 up there. It's really hard to bring it down once you get those low numbers. A lot of stuff is just sticky, right? And it'll take quite a while, right? And so that's really the key question. And that's what we don't know. The bond market is just guessing that they're going to have to cut. That's why the 10-year keeps dropping. That's what the bond market's telling us. Oh, they're going to have to cut, man. Things are softening up. Things are softening up, right? And understand, I don't care how good you are at this, even the best of the best can't get it right. Just look at Stanley Druckenmiller, who I have a boatload of respect for, right? One of the best hedge fund managers of all time.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23, I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad.
And again, I mean, I think a lot of people were predicting that. The market even predicted in 2022. They were trying to get ahead of it, right? They're trying to say like 3 to 6 months ahead. So they started selling down the market at the beginning of 2022, thinking it was going to hit mid to late 2022, and it didn't. Okay, so that's what this 2020 shutdown did. When you shut down the world, you throw everything off, and it throws the cycle off, okay? And so here we are. And so, you know, I can't read into what the Fed is going to do. And again, there's no rhyme or reason to when the market would come down, because it don't matter. That's why I'm saying people are lying to people saying, oh, when they make that first cut, that's when it's going to drop. And I show clear as day from 2000 to now, all three of them scenarios were different. Okay, so that's what you got to keep in mind on that. Now, it kind of leads us into our next question from Dr. Marcus. It says, hey, Mike, question for you. If NVIDIA earnings crush and the next CPI is relatively good, can you see any reason as to why the market won't continue to pump up through the summer? Then with elections and likely rate cuts in September, I just don't see how we don't keep pumping unless black swans happen. I think the black swan event is always on people's minds because you just don't know. But I think the bigger question to look at here is everything we just talked about, but also add this in. Liquidity. What is going to start happening here very soon? We know the Treasury is going to start buying back bonds. I believe it's on the 28th of May. I could be wrong. Correct me on that date. And then in unison, the Fed is going to cut half of what they were rolling off their balance sheet, right? So that's liquidity, right on top of that. But then if this gets approved, which is just crazy, and again, we don't know all the stipulations and regulations as far as I know, but Freddie Mac's second mortgage plan, as even Jim Carson said, we're talking about that could put trillions of dollars of liquidity in the market. And what am I talking about, right? So April 22nd, Freddie Mac proposed to begin purchasing second mortgages. And so if they do this, I'm just going to cut to the chase on this. What this means is, you know, people aren't taking second mortgages because they'll have to take it out at higher rates. But when you look here, what's going to happen is if, let's say you have a 3% mortgage, you're going to be able to take out a second mortgage of some amount and keep the same interest rate. Can you imagine that? Instead of having taken, let's say, a 7.25%, and you're sitting at, let's say, 3, you get to take it out at 3, folks. That is crazy. And so in this example, you would save $600 a month on that payment. And again, I don't know what the restrictions are going to be on this, but do you not think people are going to take advantage of that? And you're talking, let's say, I mean, think about that. If you could, what's crazy about it is, and this is going to be interesting to see, if people aren't going to take out second mortgages, let's say like mine's 2.25, I believe. And so if I take out second mortgage and threw that money in a money market fund, right? I'm doubling, and the money market fund is going to pay for that loan, and I get to keep the other 2.5% in my bank, right? I mean, I wonder if people are going to do that. Again, I don't know the restrictions. We don't know all the layouts of this. But if they pass this, which again, it's an election year, they're trying all kinds of stuff behind the scenes to keep this party going, right? And if that happens, you got a boatload of people around this country. Let me know if you're one of them in the comments that are sitting on a lot of equity at a very low rate. And the reason why we don't take anything, HELOCs or anything else out, because the rates are way too high. It makes no sense to me to do that whatsoever. But if you're telling me I can get it for 2.25, I'm like, look at that right there. I mean, that's a crazy thing. You'll see, and again, I don't know the restrictions there. You'll see people, you know, they'll probably start taking out second mortgages just to go put another down payment on another house if rates start to come down and prices start to come down in housing. So, I mean, it's all kinds of things that can happen. But either way, and then some people, of course, the reason they're really doing this is to, one, get money out there into the economy any which way they can, right? And so, but either way, that's what's going to happen. And so, can the market, and you'll have people, don't get me wrong, I always say you never do this with your house, but they'll take the second mortgage out and they'll throw it in the stock market or the crypto market or wherever. Maybe they throw it in the bond market. Maybe they lock up a bond, right? The bonds. And so all kinds of crazy stuff could happen on this. But that's liquidity. And liquidity is king. And if that happens, absolutely, forget NVIDIA. Look, unless NVIDIA says something crazy, you know, they might pull, I forgot what stock it was. It dropped like a rock on earnings. But they may drop NVIDIA no matter what they say on earnings, right? Just to buy it cheaper and then run it back up. It was, I'm sorry, it's freaking Meta. Thank you. Meta dropped like a rock. Their earnings weren't even that bad. And then what happened? They bought that thing up after hours in pre-market real fast. Now it's almost closed the whole gap, right? And so that could happen as well. They could kill earnings and still get dropped, but then just get bought up. And we know if it's the chip king, of course they're going to buy it up, right? Why buy it at 1,000 or 1,200 or whatever it's going to be in earnings next week when you can, I don't know, buy it at 900 or 800 or whatever they want to do, right? So, you know, NVIDIA is just one piece of the puzzle, but the more important part is to look at the big picture, which is liquidity and stuff. And they're doing everything they can to provide liquidity, and it is an election year, so they tend to kind of do that stuff. The electors, or the senators representing the president, want to get reelected and keep their job. And what do? You buy votes. That's what you do. Okay, and so that's just my take on that one. Let me know what you guys think about that. Now, this right here says, could you explain how long-term investments in future contracts work and why you would or wouldn't invest in them in your long-term portfolios versus like ES, SPY, things like that? And so, again, I'm kind of a novice when it comes to the futures thing, been trying to get better at it, and that's one of my main goals this year. This is why I think the answer is, I really believe it's because of margin. Okay, unlike you buying options or anything like that, I think because you have margin requirements here and you can get margin call. If there's a big drop in the market, you will be screwed. Okay, again, if it's not, wonderful. But again, it's just a big risk you're taking in a way, and you can make a killing. But that is my guess. It's just simply because of margin requirements. So please, in the bottom, if you have a better answer, put it in the bottom. Let us know if you're a big futures person. I'm just curious. But that will be my bet on that. Now, of course, if you're just buying SPY and QQ outright, obviously, you're not buying it on margin, you don't have to worry about that. But if you're buying like options versus this, I'm not sure if you're asking like options on the SPY QQQ versus future contracts, but like options, you pay $1,000 for an option, that's the most you can lose, right? And the future contract's different. Okay, and so you can get margin calls. All right, so that's my answer on that one. But please let me know on the bottom if you got a better one. And then the last one, could you share your RSI setting on the weekly, like mentioned, for a long-term time frame? Whatever TradingView has, that's what I use. I never mess with the settings. If you have found that there are certain RSI settings for a long-term investment, please put it down at the bottom, and then this person can look at it, and everybody can look at them and test it out and stuff. But I just use whatever TradingView gives and stuff. I find that works best for me. I tried manipulating things around before, and I was like, forget about it. So, you know, that's what I go with and stuff. So please let us know in the comments what you do. Again, appreciate you participating. If you have any more questions, put them in the bottom. We'll put them on next Saturday's video as well. I appreciate everything, guys. Please hit that like and subscribe button on your way out. Tomorrow we'll set up for the week with tomorrow's video, so don't miss that. And so go enjoy the rest of your weekend. Thank you for watching. Have a good one.